Stay invested, be disciplined, and don't try to time the market. Don't look at the headlines and make your investment decisions based on what's in the headlines. Be diversified. Good morning. Welcome to Life in the Markets. I am Steve Virkler, and I'm a wealth manager here at Life Financial Group. And today is Monday, April 20th, 2026. It was quite a week in the markets last week, historic week, in fact. And we're going to get to that in just a moment about why it was so historic. Let's think back to where we were 1 week ago at this time. The markets had just come off a very strong week overall. Markets were reacting very strongly to the potential for peace talks with Iran over in Pakistan. And the markets, there was a rally that had paused somewhat on Friday, but still overall, the markets had done pretty well the week before. There was a fragile ceasefire in the Middle East in the war in Iran, and the peace talks, however, had collapsed over the weekend. And something else that also happened important last Monday. The previous day on Sunday, President Trump announced a U.S. naval blockade of the Strait of Hormuz, which added even more uncertainty to the markets. And that blockade actually started at 10 a.m. Eastern Time on Monday, which is just shortly after the markets opened here in the United States, and shortly after we met with you about 1 week ago at this time as well. So there was a lot of uncertainty in the markets and what to expect for last week. Now, last Monday did start shakily in the markets, and the markets did start a little bit slow, and there was some expected volatility continued to happen in the markets as well. So we weren't sure what to expect, but volatility seemed to be something that was reasonable to expect last week in the markets. However, by close of the market on Monday, the stocks had recovered and closed higher on news that Iran had contacted the U.S. administration to discuss a peace deal. So this was a promising start to the week. But there were still potential problems on the horizon, one of which is that Iran had continued to insist on having a nuclear program, and that was a big roadblock to those negotiations. And also, the announcement of the blockade by President Trump raised fears about potential extensive and prolonged disruptions to worldwide energy supplies. And this blockade would stop all maritime traffic going in and out of the Strait of Hormuz, leaving Iranian ports. So the question was, would there be potential for renewed escalation in this conflict? So with all this uncertainty, who knew 1 week ago today that we were about to experience a historic week in the markets, and historic in a good way? So the day after that, on Tuesday, there was better than expected March PPI report, and that was what's called the Producer Price Index report. And that showed that March PPI, the Producer Price Index, rose only 0.5%, which had been, actually expectations for that had been about 1.1%. So that was positive. There were also some positive earnings results coming in from some of the larger banks, which we're going to get to in a moment as well. That was good news. Core goods prices increased just 0.2% in March. That was the slowest monthly gain in 4 months. And so that was a positive news item as well. And that gave us a clue that possibly the tariff-related pricing issues were subsiding a little bit. So that was encouraging. Another important piece of information that came out on Tuesday, import prices rose less than expected, and it was well below the estimates of 2.5%. It actually increased only 0.8% in March over the prior month. So all good news. And then Wednesday happened. We reached a new market high on Wednesday, and for the first time, and this is where the historic part comes in, the S&P 500 closed over 7,000 for the first time in history, fully reversing the 9% drawdown that had resulted from the war in Iran over the previous month. And get this, it took just 16 days from its March 30th low to reclaim that record. And the ceasefire agreement and the resumption of tanker traffic through the Strait of Hormuz all added to that as well. So the historical note on that, has something like this ever happened before? Well, there have been other times that the S&P 500 has recovered from a pullback of at least 8% and then reached all-time highs in less than 4 months. So this has happened before. Those years were 1986, 1997, 2000, 2007, 2020, and then 2024 and 2025. So this has happened recently in the markets, and these stocks typically have reached new all-time highs following those pullbacks. So the S&P 500 historically has returned 5.5% over those next 6 months. So again, history is no guarantee of future performance, but this is still encouraging, and it's not totally unprecedented. Another piece of news from last week was low jobless claims continue to signal a steady labor market. So we were continuing to get positive news last week in the markets, and by Friday, the S&P 500 and NASDAQ closed at new record highs for the third day in a row. And this was also coinciding with Iran announcing that the Strait of Hormuz was going to be open to commercial shipping during a 10-day Israel-Lebanon ceasefire. So all positive news. So how did we end up for the week? So we had 3 consecutive days of record highs. That's the first time that's happened since October of last year. And it was driven by a sharp rebound in technology stocks. The best performers last week, the best sectors, were technology, up 8.23%, and consumer cyclicals, which was up 6.35%. And by consumer cyclicals, we mean non-essential goods. So that means people are still spending on things that maybe they don't necessarily need. So that's actually a good sign. Worst performers were energy. It was down 3.54%, not a surprise. And also utilities were down 1.43%. Of course, those fluctuate on fuel costs. So the fact that energy and utilities were both down was not surprising last week. Another big story from last week was the oil sell-off. There had been a 2-week decline in oil prices, and this was accelerated on Friday. Oil prices on Friday fell 9%. Now, there is still geopolitical risk involved, but that geopolitical risk was reduced somewhat as the Strait of Hormuz was reopened to traffic. And why are we so focused on the Strait of Hormuz? Keep in mind that the Strait of Hormuz handles about 20% of global oil and gas flows worldwide. So that's why this is having such an effect, not only on the U.S. markets, but global markets as well. U.S. crude oil was trading around $83 a barrel on Friday afternoon, and that was down from a week earlier when it was trading at $96 and down from its recent peak on April 7th of $113. So that is good news. The price of oil is coming down. It's moving in the right direction. However, year to date, oil is still up more than 40% as of Friday. But the price of oil, like I said, is heading in the right direction. So what does falling oil prices mean for us? Potentially easing of inflation. And also, the thing that we probably see every day is potentially reduced gas prices. So that is something we'll be on the lookout for. Something else that we learned last week that was very positive was earnings season is off to a solid start. Now, what do we mean by earnings season? Well, 4 times a year, roughly 2 weeks after the end of each quarter, there's what's called earnings season. This is where public companies release financial results for the previous quarter. So we have just finished the first quarter of 2026, and this season usually lasts around 4 to 6 weeks. Usually, major banks start that off, and this quarter was no exception. The 6 largest U.S. banks in the United States reported better than expected earnings per share for the first quarter, and that was a very, very positive thing for the markets to hear. Some of the CEOs of these banks mentioned that these results bode well for the economy overall. And here's a few quotes I want to share with you. Bank of America CEO Brian Moynihan had this to say: "We saw healthy client activity, including solid consumer spending, indicating a resilient American economy." JP Morgan CEO Jeremy Barnum had this to say: "It is notable that the client sentiment, especially in the U.S., seems quite resilient, considering the amount of uncertainty you have in the Middle East." I don't know if you caught that, but there was a common word in those 2 quotes, and the word was resilient. And that really encapsulates the economy in our country. It has generally consensus is that there is a resilient economy in place in our country. And the general consensus is also that the higher gas prices has not hurt consumer spending yet. So it's still something we're going to keep an eye on, but it's still some encouraging information as well for us to consider. There are still some risks out there. There's, of course, geopolitical risks. There are volatility with energy prices, and also trade uncertainty still is out there as well. So still some things to keep a lookout for, but generally there is a resilience in the United States economy. Still, the positive earnings results from these banks has affected the earnings outlook overall for the S&P 500. EPS, or earnings per share, growth has been now revised up to 12% for the next quarter. Now, why is that important? If that does come to happen and 12% is realized in earnings per share for the S&P 500, it would mark the sixth straight quarter of double-digit earnings growth. And where is most of that growth expected to come from? It's expected to come from technology, which the expected growth is actually going to be 40% in some of the revised estimates. 8 of the 11 sectors that are tracked by the S&P 500 are projected to post year-over-year earnings per share gains. So that bodes well for a well-diversified portfolio. So if you're invested in a lot of these different sectors, are positioned well for the next quarter. What are some things we can expect and be on the lookout for in the week ahead? Well, on Tuesday, we have a report coming out that will show us how the March retail sales were, and that's a primary economic indicator of economic growth and potential higher corporate earnings. And also related to that, on Friday, the University of Michigan Index of Consumer Sentiment will come out as well. So that'll be very telling to see if we continue this momentum with consumer confidence and consumer spending. And also on Thursday, weekly unemployment claims will be released, and we've already said that those jobless claims have been reduced. So this could signal that the labor market is continuing to be strong, or is it leveling off, or are there any warning signs in there? And of course, this kind of report about unemployment does influence the Federal Reserve interest rate and their decisions in doing that. And they have a key meeting coming up on April 29th. So you can be sure they'll be studying the results of that report as well. Some other things we'll be looking at this week. Obviously, we're going to continue to monitor what's going on in the Middle East, the Strait of Hormuz traffic. Even this morning, there's some uncertainty as to whether which ships are coming in and out of the port. And President Trump is now sending more negotiators for more talks with Iran. So there's a lot of uncertainty. That sounds familiar, doesn't it? 1 week ago today, we had a lot of uncertainty, and here we still have a lot of uncertainty today, this morning as we start this week. But we saw this past week how much geopolitical events can impact the markets, and it will likely continue to do so as well. So one thing I wanted to mention to you, take a look at this chart. Do wars and geopolitical crises really matter to stocks? Research has shown that geopolitical conflicts have had little long-term market impact. Now, they will have an impact in the short term, and markets tend to react pretty quickly, as we have seen over the past month, to geopolitical shocks or events. But over time, markets tend to bounce back, and it is the strength of the overall economy, not necessarily the headlines, that determines which way the market will head. And you can take a look there and see those are 10 geopolitical events going back all the way to 1980. And you can see some of them, the Iran-Iraq conflict in 1980, the Iraq War, the Crimea annexation, the Russia-Ukraine conflict. In 8 of those 10 geopolitical events, you can see that within 1 year of the associated low after a geopolitical event, the markets were positive. 1 year from those events. And look at that third column. 3 years later, in every instance, the market was positive. And you can see those numbers. In many cases, the market was up substantially. So again, history is no guarantee of future, but you can see in the past, the markets have reacted overall pretty well to geopolitical events and shocks in the past. And you can see that that chart really drives that home. So right now, we are in the midst of that. And the lesson for us in this is stay invested, be disciplined, and don't try to time the market. Don't look at the headlines and make your investment decisions based on what's in the headlines. Be diversified. We already talked about how the S&P 500 is well positioned in 8 of the 11 sectors to have a positive quarter coming up and a positive year as well. Maintain that long-term perspective and avoid making decisions that are reactive. Don't time the market. Don't let headlines dictate your investment strategy. We're already seeing this in play out in the markets over the past few weeks, how you need to stay invested, because if you had pulled out your investments a few weeks ago when things looked kind of bleak, the market was down, you would have missed out on these last 2 to 3 weeks of great market growth. So the lesson here is don't overreact, but just stay invested, stay disciplined. I want to close this morning with a verse from 1 Chronicles 16:34, and here's what it says. Give thanks to the Lord, for he is good. His love endures forever. Even in the down markets and even in the positive markets, we can rest in the fact that the Lord is good all of the time. And we should be thankful for that, and we can rest in that fact as well. His love endures forever. Our ultimate trust is in the Lord, not in ourselves, not in the markets, the headlines, all of that. Our trust is in the Lord, and his love endures forever. We can all rest in knowing that this morning. I want to thank you for your time. I hope you all have a great week, and God bless.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.